Another important point of discussion for Past 7 is the discussion on cash equivalents. So cash equivalents are defined as short-term, highly liquid investments that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. Again, this can be easily asked as an identification question. So make sure to remember the definition of your cash equivalents. However, when you reach your intermediate accounting classes, a rich source for problem questions would be the computation of your cash and cash equivalents. So it's not enough that you know that cash equivalents are short-term, highly liquid investments. You should know what kind of short-term investments qualify as cash equivalents. Because when we say short-term, normally that means 1 year or less. So does that mean all investments that have a maturity of 1 year or less are considered as cash equivalents? The answer is no. Because aside from being short-term, highly liquid investments, there's another requirement, and it states that these investments must be subject to an insignificant risk of changes in its value. So it's not enough that it's short-term. It should be very short. There is no more significant risk that its value would change. So what then will constitute your cash equivalent? And this is now where our 3-month rule comes in. The rule is if you acquire it 3 months prior to its maturity, then that would be considered as a cash equivalent. Now, this is where students normally get it wrong. They would think that the 3-month rule applies to the original maturity or to the remaining maturity. That is wrong. So as to the first source of error, students would think that those investments that have an original maturity of more than 3 months will no longer be considered as a cash equivalent. Again, that is incorrect. The 3-month rule is to be reckoned from the date of its acquisition. You ask the question, when I acquired this investment, how far away was it from its maturity? So when you acquired it 2 months away from its maturity, even though its original maturity was for a period longer than 1 year, then that can still qualify as a cash equivalent. Why? Because when you acquired the investment, it was already 2 months away from its maturity. So again, the reckoning is the date of acquisition. The question you ask is, when I acquired this investment, how far away was it from its maturity? Do not ask anymore the original term of the investment. But of course, problems will give you the original term so as to confuse the students. So you are now being warned. As for the cash equivalent classification, the original maturity or the original term is of no moment. The important detail here is the date of the acquisition. Second common source for error for students in identifying cash equivalents would be on the remaining maturity. So let's say, for example, on June 30 of the current year, an investment was acquired, and on such date, the investment was 9 months away from its maturity, meaning it is going to mature at the end of March the following year. So by December 31 of the current year, it will just be 3 months away from its maturity. Again, it was acquired on June 30 of the current year, expected to mature on March 31 of the following year. So on the date of acquisition, it was 9 months away from maturity. So the question now is, on December 31 of the current year, 6 months after the acquisition, 3 months away from the maturity, should the investment be classified as a cash equivalent? The answer is no, because even though at present it is just 3 months away from its maturity, when it was acquired, it was still 9 months away from maturity. Again, the most important date here is the date of acquisition. And it should be that on the date of acquisition, it should be at most 3 months away from its maturity. And I cannot emphasize that enough, class. Those two misconceptions would be the most common source of errors in identifying cash equivalents. They would think that the original term or maturity matters. They would think that they would only have to check the remaining amount of time until the investment matures. Now, that being said, since we're talking about maturity, the natural expectation is investment in equity instruments, investment in the shares of another company, would never be classified as a cash equivalent. Why? Because equity instruments do not have any maturity. So how can we say that it is so close to its maturity that its value will no longer change when in the first place it does not have any maturity? So again, as a general rule, equity instruments or equity investments or investment in equity instruments or investments in equity shares are not going to be classified as cash equivalents. We have one exemption, however, with regard to equity investments as to form but in substance are actually debt instruments. So in a way, it should not be considered as an exemption because in the first place, its true substance is that it is a debt instrument. So what do we mean? If you have an equity instrument that has a mandatory redemption period, then that may qualify as a cash equivalent if it was acquired at most 3 months away from its redemption date. So the fact that it has a mandatory redemption date tells us that these equity instruments are actually in substance a debt instrument because they possess a maturity date. Now, one scenario class that should be considered as tricky for many beginner students would be the classification of overdrafts. What do we mean by overdrafts? When do we have overdrafts? When we talk about overdrafts, we are definitely dealing with a bank here. So you have a bank account and you have been issuing checks, but on a particular day, a check was presented for encashment, but the current balance of your checking account was not enough. So of course, if you're a valued client, the bank will not allow the check to bounce. Instead, it would honor the entire amount even though you have insufficient amount of money in your account. So to concretize our example, let's say a check issued by you in the amount of 200,000 was presented in the bank, but the balance in your account is only 150,000. So instead of allowing the check to bounce, the bank still honored the entire 200,000 even though you only have 150,000. So in a way, your 150,000 was consumed and the bank shouldered the 50,000. So we can actually say that you borrowed 50,000 from the bank. This is already a common arrangement. The banks have policies as to the amount they would charge their clients for every 1,000 of overdraft and for the number of days it remains unfunded. So as to the execution of these transactions, these should not be tricky. But as for the classification, how then are you going to classify the 50,000 that we borrowed from the bank when the bank shouldered the deficiency in our bank account? If you recall, if it involves borrowing of funds, it would be considered as a financing. But this is what the standard says. If the overdraft arrangement is already part of the cash management policies of the entity, then it would be considered still as part of your cash and cash equivalents and not as a separate financing activity. Again, just be careful for that kind of arrangement. It's very easy to convince you that perhaps it's a financing activity, but again, if it's already part of the cash management policy of the entity and it is payable upon demand, it will not be considered as a financing activity. So if you go over the standard actually gives you multiple examples of cash flows that would be considered as a cash flow from operating activity, investing activity, and financing activity. So my advice for students would be to familiarize themselves with the examples given in the standard because those would be a good source for questions. The question will just be like this: which of the following is not a cash flow from operating activity? Which of the following is not a cash flow from investing activity? Which of the following is not a cash flow from financing activity? But definitely, if you just apply our guiding principle in the classification of your cash flows, then you can for sure get the answer. But remembering the exact examples given in the standard will not hurt our chances of getting as many questions as possible. So we will no longer go over each example given in the standard. I will leave that to your care. But I'll try to help you identify specific cash flows mentioned in the standard that are not presented as part of the enumeration but are just sprinkled throughout the standard. Now, PAS 7 mentions of a particular kind of transaction wherein the classification contravenes to the common or usual classification. So for example, if you dispose of your property, plant, and equipment, and if you'll apply our guiding principle, since property, plant, and equipment is a non-current asset, then cash flows arising from its disposal should be considered as an investing activity. However, as referenced by PAS 7, a provision in PAS 16 tells us If the disposal of an item of property, plant, and equipment is actually in the regular course of business, or it pertains to assets that are held for rental to others but are regularly sold to outside parties, then in reality, such asset, such property, plant, and equipment is actually not held for rental only but actually already for sale, which would make it as part of your principal revenue producing activities. So to simplify the scenario, you have an asset that is held for rental to outside parties, but you also regularly sell these assets to outside parties. That would now make the sale of such asset not as an investing activity, but instead an operating activity. So where then is the distinction? When then is a disposal of PPE an investing activity? When is it an operating activity? The determining factor would be the regularity. If you regularly sell the assets that are being leased out, then that will now be considered as an operating activity. But if the sale of your assets leased out to your customers is isolated, when such leased asset is actually sold, then that would still be classified as an investing activity.